Joining us now is William Cabangon of AAA Southeast Equities. Will, right move for Eli Remolona and the Monetary Board to raise the cost of borrowing inter-meeting by 0.25%.
I'm not sure if it's the right move, but I think he had his hands tied. We saw inflation come down quite significantly this year and then take a U-turn and head back up. I think this government has put inflation at the very top of its priorities, and that meant the central bank had to raise rates in anticipation of this continuing the wrong way.
All right, they're raising the inflation targets for 2024, but they're still not moving or budging from the original target of 2 to 4% for 2023. Why so? And do you think that this interest rate hike will have an impact in any way in November or December?
Well, as far as sticking to this year's target, someone has to play cheerleader and hope that we can still make it across those goalposts. But I don't think that at this point is a realistic target. Going into the end of the year, I'm not convinced that this surprise rate hike will have much of an impact. After all, we're heading into the holidays, and businesses have already signed all of their supply contracts. All these prices have already been set. So I'm not convinced that this is what it takes to lower inflation to close out the year.
So when will it have an impact? This 0.25 point, now at 6.5% starting tomorrow.
I don't think that we see an effect well into 2024. So there is a significant lag before we start feeling the effects.
And even Eli Remolona said that there is a lag. We are behind the curve in terms of tightening monetary policy. So could there be yet another interest rate hike to 6.75% for it to have a significant effect on inflation in the early part of 2024?
Well, I don't see why they wouldn't do that. After all, this off-cycle hike meant that they have catching up to do. So, the rush to raise rates now versus at their next meeting means that they probably still have more in the pipeline.
But, of course, for our kababayans, when you talk about borrowing rates, interest rates, 6.5%, it just flies over their head. What's important to them is the bottom line. How will it affect the food on their table? Eggs, onions, vegetables, rice inflation, which is the highest level since 2008. When will it have an impact on their prices?
The sad reality is that the biggest contributors to Philippine inflation, gasoline, rice, like you mentioned, we don't produce any of these things.
All imported.
We import all of it. So the rate increases of the BSP are not on the radar of Saudi Arabia when they price their barrels of oil. So really, I'm resigned to the fact that we are subject to global prices of these commodities. So when those prices will come down, I think is out of the BSP's hands.
Out of the BSP's hands, but of course they can also infuse and defend the peso against the US dollar, so we will have a stronger peso against the US dollar. So when we import, it's much cheaper.
That's true. That is the main lever that they can use to help lower inflation in the Philippines. It's defending the value of the peso. However, there is a trade-off there that by increasing rates to defend the peso, they might be sacrificing economic growth locally.
So it is a double-edged sword, raising interest rates, strengthening the peso. So what is the outlook right now of AAA Southeast Equities for the fourth quarter in terms of growth with rising interest rates?
I'm not going to sugarcoat it. I think we are in a much tougher position now than we were this time last year. Last year was very clear. Inflation was rising, we had to raise rates, and growth was not an issue. And now we took all those problems, and now we're throwing growth on top of that. We still have inflation as a problem, and now there's a growth concern. So the outlook, at least for the next 6 months, is not a rosy one. For investors, the best place to park your money right now is in fixed income. Rates have been at the highest level that they've been for years, so the easy money is there. Time deposits, 6%, 7%. Should make investors happy.
Fixed income is the best place right now to invest. What about the stock market? It just continues to fall.
That's right. So right now, stocks are at a pretty attractive valuation. But the problem is, when you have large investors, pension funds, insurance companies, when they can safely park their money in fixed income and earn the 7% that they target every year, we don't have enough participation in the stock market to really boost those valuations up. So you could very well buy cheap, but if the big boys don't come and buy those same stocks, you're really left waiting.
And how do we stack up against our Southeast Asian neighbors in terms of stock market valuations? And which particular sectors remain attractive for local players?
Well, on the valuation side, we are on the cheaper end of things regionally. But looking at sectors that are outperforming, it's definitely the banking sector. A lot of those banking names are at or near all-time highs, mainly because they are the beneficiaries of these rising rates. All of that money they have of customers, they can now suddenly turn a higher profit on that. Loans are priced higher, so they're really the biggest beneficiaries.
And right now, any fundamentals that could potentially boost the stock market before year's end? As they say, in December, you have the Santa Claus rally. But of course, if the government is cheerleader for 2 to 4% inflation target, will they still be a cheerleader for 6 to 7%? Is that still attainable in terms of growth targets for GDP by year's end?
I think the growth targets for this year of 6 to 7%, I don't think those are realistic now either. We saw growth be dragged down by private sector investment. Private sector isn't investing right now, given the very high cost of borrowing. So the government could try and pick up some of that slack, but it really won't be enough to bring us back to that 7% target.
Things are not looking very rosy until the end of the year. Will Cabangon from AAA Southeast Equities, thank you so much for your insights.
Thank you very much.